preferred returns, equity splits, profit distributions. If those terms have ever made you pause when looking at a real estate deal, this video will make them crystal clear. When people first look at a real estate syndication, the structure can feel a little confusing. You'll see terms like 7% preferred return or 70-30 split or quarterly distributions. And you might be thinking, okay, but what does that actually mean for me? So today, I'm going to break this down in simple real-world terms so you understand exactly how past investors just like you get paid. So first, let's start with the term preferred return, sometimes called the pref. A preferred return is the minimum return investors are paid first, before the sponsors participate in profits. For example, if a deal offers a 7% preferred return, that means investors are paid up to 7% annually on their invested capital. The key is that this is paid before the sponsors or general partners get a share of the profits. Think of it as investors get paid first. So let's say you invest $100,000 in a deal with a 7% preferred return. That means you're targeted to receive $7,000 per year. Now, the important thing to note here is that typically this is not guaranteed, but it is the priority for the payment structure. In other words, the sponsor doesn't get paid until you do, which tends to keep everyone very motivated. Next, what exactly is an equity split? So once the preferred return is met, we move into profit sharing. This is where the equity split comes in. This basically defines how profits are divided between passive investors, known as limited partners, and the sponsor team, known as general partners. For example, let's say you're looking at a deal that says it's a 70-30 split. This means 70% of the profits go to investors and 30% goes to the sponsors. So how does this work in real life? Let's say the deal generates profits beyond the preferred return. That extra profit split is based on that structure. So if there's an additional $100,000 in profit, $70,000 goes to investors and $30,000 goes to the sponsors. The big thing here is that this structure creates alignment because the sponsor only does really well when the investors do really well. It's not just a we win, it's a we win together, which is exactly how you want it structured. So now let's talk about how and when investors actually receive money. These are called distributions. Most deals pay quarterly or monthly. Occasionally you might see one that pays annually, but that's pretty rare. The most common frequency is quarterly, and this money goes directly into your bank account. Now, there are two types of distributions. One, cash flow during the deal, which comes from rental income after expenses are paid. This is where your preferred return is often paid from. And two, profit at the sale. These are your capital gains, typically pretty significant, that you receive when the property is sold. This is the big payout. At this point, investors receive all remaining profits. This is where the equity splits are applied and your capital, your original investment amount, is returned to you. So essentially, cash flow, your quarterly distributions, this is your ongoing income. And then the sale, this is your big upside payout. Here's a simple way to think about it. Preferred return, investors get paid first. Equity split, profits are shared after that. And then distributions, that's how and when you get paid. So instead of guessing how you make money in a deal, you can actually see exactly how the structure works before you invest. Once you understand these three pieces, something important happens. You stop looking at deals emotionally and start evaluating them strategically. And that's when you start investing like someone who truly understands the game. If you want to see real examples of how these structures look in actual deals, join my investor list using the link below. I share opportunities, breakdowns, and insights to help you invest with confidence. And if this video is helpful to you, hit subscribe. Check out this next video, 5 questions to ask before you invest in a real estate syndication.